Welcome everyone to another Maine SBDC webinar. My name is Kelsey Reardon and I am with the state office hosted by USM. And today we are joined by another Maine SBDC state office business advisor, Tina Oddleifson, as well as our accounting specialist, Kitty Barbee, who they are going to help you avoid some issues. So we were saying, it's great to know what to do, but sometimes it's more helpful to know what not to do. So we're going to go over what not to do with bookkeeping today, essentially. And I will follow up probably tomorrow with a link to the recording of today's session, as well as the slides and all of our contact information. So you'll be able to access all of that. Please stick any questions you have along the way in the chat. We will definitely have time for Q&A at the end to go over all of those. But to ensure we have enough time for all of your questions, we're going to go ahead and get started. So I will pass it over to Tina to start us off today.
Awesome. Well, thanks, Kelsey, and welcome everybody to Don't Do That, Common Bookkeeping Errors and Why You Should Fix Them. When we were thinking about setting up new SBDC webinars for our SBDC clients, it really occurred to me that people learn often the best from mistakes. And as an SBDC advisor, and Kitty is also advising clients, we see very consistent types of mistakes happening when it comes to bookkeeping. So the intent of this webinar is really to hopefully, for those of you who are already doing your bookkeeping, if you see any of these problems and you see that you're doing them, don't panic. It just means that you might need some help. And then if you're new to bookkeeping, hopefully this will give you a heads up or a roadmap of things not to do. So before we get going, we just wanted to say a little bit about us. Most importantly, we've both been in your shoes. I was a small business owner for 12 years. I ran an inn and a restaurant and had about 20 employees. And I did my own bookkeeping. And even with a finance background and an MBA, I have to admit that I really didn't get it until I had to do my own bookkeeping. And I made a lot of mistakes along the way, and I learned from those mistakes, and hopefully that experience will help all of you. And I'm very, very pleased to be joined by Kitty Barbee, who is the owner of Barbee Business Services. So not only is she also a business owner that does her own books, she does this as her business. She's a certified tax preparer, Quickbooks Pro advisor, and also does bookkeeping for small businesses. And what's wonderful is that Kitty is working with the SBDC to advise our clients free of charge to you. And she will be with us through September and hopefully beyond that. So if you need some very specific help, then you can request advising with the SBDC, and then we can also set up a meeting with Kitty. So what we're going to be covering today is I am going to be covering some of the larger, common, big picture reasons that business owners are making mistakes inside of their bookkeeping software. And Kitty is going to speak specifically to those mistakes we see over and over again, and she's going to dive into those and help you know how to avoid them. We have some time for a Q&A at the end, and I just want to say that when it comes to bookkeeping questions, sometimes it may be our best advice will be to set up an advising session, because sometimes we can't really answer those questions until we actually look at what you're doing, but we will do our best. And then we'll just end with a slide about where to get more help and information. So I wanted to start with some fun statistics here because I think that they tell an interesting story. The first is that most small business owners, particularly, very small businesses, the owners are doing their own bookkeeping. And I think that's great because you as the owner know the most about what's happening in your business, and need to get that financial data and make sure it's correct. So that's a good thing. But what's not such a great thing is a lot of small business owners also feel like they don't know what they're doing. So if you feel like that, you are absolutely not alone. But an unfortunate consequence of that is 82% of small businesses that fail are failing because of lack of financial management. And your financial management, and particularly understanding cash flow, but financial management starts with your bookkeeping. So this is a really important topic. And you know, we know that you did not start your business because you wanted to be doing bookkeeping or accounting, and you're not expected to, but hopefully with this, the information we're going to give you today, you'll know enough to know when to ask for help. You might not know the answers, but you should know, as my mom used to say, stop, look, and listen before you cross the street. So just stop if you think that if you're not absolutely sure what you're doing with any individual transaction. So I wanted to start with this too, because it may seem super obvious, but it's just a reminder that your bookkeeping system, to me, is just a massive organizational system, and each individual financial transaction from your bank accounts, credit card accounts, loan accounts, all get categorized in your bookkeeping. But ultimately what you're after here are the financial reports that all of that information gets summarized on. And those financial reports are so important because you use them to pay your taxes, but you also use them to make really critical management decisions about your business. And you know, you may need to change course because something is not working the way you thought it would be inside your business. So you use financial reports to do that. That's the tool that we have. If you ever need to get a loan, or you want to have investors in your business, or if you ever go to sell your business, you also need to have up-to-date, accurate financial reports. So not using the right accounts inside your bookkeeping system, not really understanding how your software works, ultimately that is going to lead to that old adage of garbage in means garbage out. So don't be like Oscar, and let's dive into understanding more of this. So as I said, I'm going to kind of talk about some of those bigger reasons that I see people making mistakes all the time. And the first on this list is the chart of accounts. The chart of accounts is probably the #1 reason I see people making mistakes. And for those of you who don't exactly know what the chart of accounts is, it basically refers to that master list of categories that you're using to categorize each and every individual transaction in your bookkeeping. And the first thing to know about the chart of accounts is that there's two essential sets. There's income statement accounts and their balance sheet accounts. And that means that income statement accounts get summarized and presented on the income statement, which is one of the key financial reports, and balance sheet accounts get summarized and presented on a balance sheet. There is a third very important financial report called the statement of cash flows, but it does not have its own accounts. It borrows from the other ones. So we're not going to be focused on that today. And I just do want to say that there are SBDC pre-recorded webinars on our YouTube channel that dive very deeply into the chart of accounts and understanding financial reports. And I really encourage you to check those out if this is complete Greek to you. So I first just wanted to do a quick overview of what's happening in your system and what I mean by these different types of accounts. So in your bookkeeping software, transactions come in, you're either entering those manually or you've connected your bank and credit card accounts. And most small business owners kind of instinctively understand income statement accounts. It's pretty instinctive that when you have a sale, that's income to your business. If you are in the business of making a product, then you are also hopefully tracking what's known as the cost of goods sold, the COGS. Those are the direct costs of producing a product. So if you're a baker, it's your ingredients, it's your labor associated with actually making the baked goods. The reason it is an expense, but the only reason we separate that out into cost of goods sold is that it helps us to see how efficient you are at creating your product in the first place. So we know if you have enough, you're making enough money to pay for the rest of your expenses and make profit. So then there's expenses, and those refer to operating expenses, indirect expenses, expenses that most businesses have, and they're not related to your sales. You have to pay your utilities and your insurance and your rent and salaries, no matter how much revenue you bring in. Expenses are also things that kind of get used up in a year. So we track those on the income statement. We look to, we run reports over periods of time, like a week or a month or a year. At the end of the year, we look at our profit, and then we start again the next year. The balance sheet is where I think I see more confusion, because a lot of business owners, especially very small business owners, don't really understand what the balance sheet is, and they don't always look at it. So a balance sheet is the financial statement that is essentially showing the net worth of your business. It's showing what you own as a business, those are assets, what you owe to other people, those are liabilities. And the difference between those two things is your equity. So just like if you had a net worth statement for a person, if you sold off all your assets and you used the money to pay off all your liabilities, what you're left with is equity. And that's your part of that's what you own of your business. So the types of transactions that end up using these kinds of accounts are when you purchase assets. So say you purchase a piece of equipment, and it's an expensive piece of equipment, like a tractor. That's not an expense of your business, that's an asset for your business. If you take out a loan and that money comes into your bank account, that's not income, that's liability that you owe to someone else. And if you as an owner set up your business and you take personal funds to open a business bank account, you've just made an owner investment, and that's an equity account. Similarly, and very commonly, many small business owners, unless they're what's called an S Corp, are not employees of their business. They take money out of their business bank account when they need money to pay their personal expenses. That is perfectly acceptable, and it's known as an owner's draw, and that's not an expense of your business, it's an equity. It affects the equity position of your business. So as I said, we have lots of other webinars that explain this in more detail, but the point of showing you this is really that you're very much aware that there are income statement accounts and there's balance sheet accounts, and that there's specific transactions that go into each type. And if you are not clear what those are, especially balance sheet accounts, then you should get some help. Accountants and bookkeepers are especially helpful when it comes to things like depreciating assets and putting your assets on your balance sheet in the first place, because that has some tricky IRS rules associated with it. But again, the point here is know that there's a chart of accounts, that there's 6 major sets of categories, and you want to be clear about when to use those. I did want to just show you an income statement and a balance sheet, which I'm sure you've seen before, at least the income statement. But as you can see on this made up company I have here, there's income, which is getting summarized there, different types of income. There's our cost of goods sold section, and there's our expense section. And those are all summarized, summarized below with our net income account. But what's really important here is this is just telling you one part of your business, one piece of your business, and there's a lot more to know about your business. That shows up on the balance sheet. So there you have your asset categories, your liability categories, and your equity categories. This is the only report you can go to see what do you have in your bank account and what do you owe people, particularly this year, like credit card balances and accounts payable, and how do those two things look compared to each other? The balance sheet is where we do a lot of ratio analysis, which is basically a fancy way of saying we compare the relationships between assets, liabilities, and equity to determine if a business is healthy. So having accurate numbers in those categories is really important. And again, we have advising services and webinars that can teach you more about this, but it's not understanding these accounts is a source of confusion and also a source of mistakes in bookkeeping. Oh, right, have that one last little blurb there. Number 2 on our hit list is not understanding your software and what's happening in the background, and specifically not following what are often known as workflows inside the software. There's usually very specific steps you need to be taking in your software to make sure that you're using it properly. And I'm going to give you an example because I see this example frequently, and this is related to QuickBooks. QuickBooks and all software, bookkeeping software, gives you the ability to make invoices and send them out to customers. So if you have the kind of business where a customer is not standing in front of you and paying, but you send them an invoice afterwards, inside the software, once you create that invoice, you have just created what's known as a posting transaction, which means it's actually posting to your financial report. So so the second you save that invoice, QuickBooks is saying, oh, you made a sale. I'm going to put that in income. It's also saying, oh, you're sending this as an invoice. I'm also going to put that number inside of a balance sheet account called accounts receivable because that tracks what people owe to you. So that's great. But what I see happen frequently is people don't understand that they already posted the income by creating the invoice, and then the check comes from the customer, and they haven't followed the proper workflow to actually connect that check to that invoice, and it comes through their bank feed and they categorize it as income again. And so what you've just done is double booked your income. This I've seen literally 3 or 4 times in the last year with customers, and the implication of that, if you don't fix this or correct this, is that you could be really overpaying on your taxes because you're reporting much higher levels of income than you actually got. So this example also exists on the flip side of paying bills. There's certain workflows, at least inside of QuickBooks, that you're supposed to take if you go through the bill paying process. So, you know, I know a lot of people buy their software and they're really excited to use it, and they connect their bank accounts and they start categorizing without really understanding how it works. So the message here is take the time to learn about your software. And there are YouTube channels, and there are SBDC advisors and Kitty and your bookkeepers and your accountants who can help you with all that. The third major reason I see, again, relates back to the chart of accounts, and we see people overcomplicating their chart of accounts. They're making lots of accounts under each of those types. And they're usually doing this for one of 2 reasons. The first is that they are really detailed people, and they say they have a office expense account. Some people will then create sub accounts and start tracking things like inkjet printer ink and paper and pens and all these different things in sub accounts. Don't do that, because only track that level of detail if you have a management reason for doing that, because by creating more and more accounts, you increase the likelihood that you're not going to be consistent in using those accounts, and you're also creating an income statement, especially, that starts looking really kind of long and hard to read. So that's one reason people do that. But there's another reason that I think is more common. And that is that people are trying to use their income statement to get information about their business because they don't know that there's other tools to get that same information. So for an example, say you are a potter and you sell plates and cups and saucers. I've seen people create revenue accounts for each type of item that they sell, because they think that's the only place they can get that information. But there are sales reports inside of most accounting software programs that let you see what you're selling, how much of each you've sold, and how much money you brought in from each, without doing that on your income statement, which just makes it kind of messy. Another example is one I had in my business. I had an inn and a restaurant. They're both very distinctive in different businesses, but under the same roof, under the same business tax ID. And there are tools inside. I was using QuickBooks. There's something called classes that allowed me to make columns inside my income statement, so I could track each part of the business separately, but roll them into one report. That's a much better tool to use than, say, having your office expense account and then having a sub account for the inn and for the restaurant. And then God forbid, under each one of those, you're having one for, you know, paper and pencils and all that. So keep your chart of accounts simple. Know the tools that are inside your software to get information that you might be seeking. It's your reports and are going to be much clearer, and you're not going to make as many mistakes. So that's another big one we see. This one I'm always actually a little surprised by, but I have talked to many small business owners who don't understand that there's an actual reconciliation process that you go through on a monthly basis inside your software. There's an actual function, and you want to do this on a monthly basis because what reconciling does is compare what you think you have in your bank account with what the bank says you have in your bank account, and credit cards and all of your accounts. And, you know, as an example, I used to, when I first started using QuickBooks, I was really eager to see my financial reports because I was a seasonal business. I needed to know what was going on. But I soon learned that never ever to run those reports until I had reconciled, because I always found mistakes. And sometimes they were pretty big mistakes. Like I would do things like write a check. And this is back in the day when you couldn't connect your bank accounts to QuickBooks. I'd write a check, and then I would put that check inside QuickBooks, you know, record it, and it would be for two completely different amounts. I was distracted, you know, you just make all kinds of mistakes. My bank made mistakes, and my husband made a lot of mistakes. He used to take our business credit card and forget that he shouldn't use that for personal expenses. So that's something that I would have to clean up before I ran my report. So really, really important to do. And if you don't do it on a monthly basis, and then suddenly you realize there's a big discrepancy between what you think you have and what the bank says you have, it's very difficult to find that mistake. So you want to do this monthly. I once had someone tell me, you can have a $5,000 mistake and you can have another mistake that's $4,999. And together they might net out to just $1 difference between what the bank says and you have, what you think you have, but it's two really big mistakes. So really important to do that regularly. And then another and final part is that I see frequently is people not running their financial statements and looking at them on a regular basis, ideally monthly or even more often. But this also surprises me, because you as the business owner, when you look at those financial reports, you're going to know if something just doesn't seem right. Like maybe you've double booked that income, or maybe you have a really large expense for food, but you're a consulting firm, you know, that there may be some really odd things in there. I've had clients send me their financial statements, and I'll look at their balance sheet, and for some reason, all of the numbers are negative. You should not be seeing negative numbers all over the place. There are certain accounts that you might have negative numbers in, but it shouldn't be a lot. And so if you're seeing that, there's something really wrong there. So get into the habit of running these reports, comparing them, analyzing them. And if you don't know how to do that, we can help you do that. But it's a really, really important exercise to do, because you know more than anybody about your business. So just to repeat, this is all going to be, your information is going to be a lot more accurate if you first take some time to understand the difference between balance sheet and income statement accounts. And if not, then to at least get help if you're not completely sure how to use the accounts. Make sure that you are taking the time to understand how your software works and what the proper workflows are inside of your accounting software. don't overcomplicate the chart of accounts, and then also understand the reporting tools that you have available inside your software, because there are tons of them now, just tons of them. You know, QuickBooks has something called tags, where you can tag an expense and track it that way. There's all kinds of great tools. And then be sure you're reconciling your bank and credit card statements monthly and reviewing your financial reports at least regularly, to just see if they make any sense to you. So those are the top 5 reasons that I see people making mistakes. And as I said, Kitty is now going to go into some really specific mistakes that we keep seeing over and over again. And she's going to demonstrate a few of those inside a QuickBooks file. So I'm going to stop sharing, and Kitty is going to take over.
All right. Thank you, Tina. I think that was a great overview of what we're going to be digging into very specifically. So what I'm going to do is take a look at some of the specific areas we have, and utilizing QuickBooks, I'll demonstrate utilizing a company called Craig's Design and Landscaping Company. All right, let's see if we can pull this up. Excuse me while I do this. All right. All right, hopefully everybody can see this. Okay, so the first one that we see again and again is sales tax. And we see business owners that are using sales tax as sort of an expense account rather than a liability account. We need to remember that as a business owner, we're just the holder of the sales tax. We charge it on products we sell, and then we turn it over to the state of Maine. All right, so remember that it's not our money. It's definitely not a deductible expense, so it should not be on your balance sheet. So I'm going to show you how we can do that utilizing QuickBooks. Theoretically, I am. There we go. All right. So this is a sample company in QuickBooks called Craig's Design and Landscaping. So what I'm going to do is, if we go to the chart of accounts, all right, I am going to look at our liability accounts here. As a current liability, we need to have something called sales tax payable. So I'm going to go up here and set it up. Current liability, sales tax payable. That's exactly what I'm going to call it. And I'm going to save and close. All right. So when I go back in to my financial transactions in here, we're going to pretend that this deposit of $55, okay, was something that we that was purchased by Books by Bessie, okay, and the first category would be some product, some decks and patios, and we're going to just say $50. But then the other line should be that sales tax payable, right? Oh, sorry, same one, still Books by Bessie. And this one is sales tax payable. And just pretend we're going to make that $5. And then we're going to apply and accept. So now when we go into our chart of accounts, oops, if we go into the right chart of accounts, we can now see that our sales tax payable has a balance of $5. Okay, so then what happens is when you write your check, whether it's monthly or quarterly or every 6 months to the state of Maine, you write that check for $5, that account goes back to zero. And that way you're always keeping track of that balance. But that is how you should be treating your sales tax. All right, so the next item that we see a lot is credit cards. All right, and we see business owners that are recording the credit card payment as a credit card expense and trying to split that between all the different accounts that were utilized by the credit card. Okay, and that's not the correct way to do it. You're going to miss a lot of that detail, right? So you're not going to have an accurate picture of where you are financially. So if we go back into Craig's Design and Landscaping, we see they have a MasterCard set up. So that's the first thing. If you have a business credit card, make sure you link it to your company file. Inside that, just like in your checking and savings account, there is the list of details of how the credit card was used. Okay, so this is where you would categorize each individual transaction. So this first one for Tanya's nursery looks like it's matched to a bill. So we're only going to match it, but that's where the detail is. Okay. And then in the checking account is where you're actually going to record the payment for that MasterCard, right? So you made a monthly payment. Let's just assume that that's what this is on 4/9 for $900. So I'm going to go up here and I'm going to pay down my credit card. All right, and this is my MasterCard. And again, I'm going to pay $900, and it was on 04/09, and it was a checking account we used. So when I save and close, it then takes care of that payment. I've got two matches here, and it's a credit card payment, and I'm just going to match that up. Okay, so you don't want to try to do the detail in the checking account. You do that in the actual credit card account. Okay, hopefully that makes sense. All right, the next item that we run into a lot is how we deal with credit cards. So we see a lot of people who, again, just have something called credit card expense, and everything gets categorized there. Again, you won't be able to track your details, right? Everything, oh, that is what we just talked about. I'm sorry. The next one is loan payments, and that is classifying the entire loan payment as an expense. A loan is a liability, and it is made up of both principal and interest. It is only the interest that is an expense, and that is the only portion of the loan payment that is deductible. So the principal portion is just used to reduce the loan on the balance sheet. Okay, so let's go back in again. Let's look at our chart of accounts. And we see here that we have a notes payable, right, for $25,000. So if we go into our bank feed, and again, we're just going to make this up. Here's a payment for $2,000. We're going to pretend it's that loan payment, that time of the month, 4/13, when we need to make it. All right, so I'm going to categorize this, and then I'm going to split it. All right, so the first category is that notes payable. All right, and because very often in the beginning of a loan, there's more being paid towards interest and principal, I'm going to say that $500 of this goes to the principal. Then we have a second category, which is interest expense, which is not in here, and we're going to add it very quickly. All right, and $1,500 of this $2,000 payment went to our interest. Okay, so then if we go and look at our reports, if we look at our balance sheet, all right, we can see that that long-term notes payable is now $24,500 because we paid $500 on it. And this is the balance sheet we're looking at because it's a liability account. If we look at our profit and loss, we can see interest expense of $1,500 that we just applied. Okay. All right, the next item that we see a lot is about how an owner gets paid. Many times, again, I'm assuming most of you might be a single member LLC or a sole proprietor, and that you take what is called an owner's draw. All right, you are not paid payroll wages with all of your deductions. You don't have taxes taken out. You don't have Medicare and Social Security all taken out. All right, you simply do an owner's draw. So once again, this is not an expense account for you. All right, it's an equity account. And what that means, it doesn't show up on your profit and loss as an expense, but in fact, it shows up on your balance sheet. Okay, so if we look at something, oh, I don't know, let's take a look at this, $75 for this week. That is our owner's draw, right? So it should be under our name, Craig. I don't know his last name, but, and we're going to call this an owner's draw. Oh. And because it's not set up, we're going to set this up. It's an equity item. And it's a, whoops, not a, partners, distribution, owner's draw, save and close. All right. And spelled his name wrong. It always helps if you spell correctly. So there's our owner's draw for him. We add. So once again, if you go up and look at your reports and you look at your balance sheet, you can see down here on the bottom that there's been an owner's draw of $75. It's an equity account. Okay. The fifth item that we often see, and this one gets pretty complicated. I'm not going to try to walk you through it, but just kind of talk you through how this should work. You really do need to be working hand in hand with the person who is doing your taxes on this. Okay. So anytime you purchase an asset that is considered a fixed asset, meaning it has a life of a year or more, you should not be categorizing that as an expense. It should be categorized as an asset, okay, that you purchased for a set amount, okay? And I can demonstrate that portion of it. If we go into our chart of accounts, all right, and we're talking about a fixed asset, right? We're gonna purchase a new asset. And it's gonna, because this is a landscaping, I'm gonna call it a zero turn mower. And we are going to say as of today, and it cost us $18,000. Okay, save and close. So we've purchased it, it's now a fixed asset, all right? Then what happens is you create a accumulated depreciation account that is associated with that zero turn mower, okay? And you do the same exact thing. It is a fixed asset, accumulated depreciation, and it is a sub-account of the zero turn mower. All right, so now you have the zero turn mower and you have accumulated depletion, or it should be depreciation. So here's what happens. At the year end, when you take your taxes to your tax person, they're going to figure out what the depreciation schedule looks like for that mower. In this case, let's say that they say, okay, we're going to depreciate 10% a year. So $1,800 is the depreciation for 2022. So then you record that depreciation by doing a journal entry at the year end that basically increases the depreciation by $1,800, and then it offset by what's called depreciation expense, which shows up on your profit and loss, and then the tax accountant can depreciate that when he does your taxes. So that one's a little bit more complicated, but I think the thing to remember is if you're buying fixed assets that have a life over a year, stop, don't just expense them. They should be added as assets rather than as expenses. All right, the next one is payroll. and we see this a lot, is really understanding what you need to capture inside of your software for payroll. So there's basically a couple of different options. If you have employees, maybe you have a payroll company who takes care of your payroll. In that case, there really are 3 different transactions that are going to show up in your bank feed. The first one is the bank fee, what they charge you, or the payroll company fee. The second one is typically called the tax liability, right? What they have pulled that's going to have to be sent out for your taxes. And the third one is wages, okay? So if you have a payroll company doing this, it's okay to just categorize those 3 transactions that way. What you need to remember is when it comes time for year-end and for year-end taxes, you're not using that information. You're using the actual payroll information that your payroll provider will give you, because they're the ones who have determined all the appropriate taxes, they do all the withholdings, and they have that on their reports. So you would submit your profit and loss, but you'd also submit your payroll information. So that's one way to do it. The other option is you can set up a journal entry, and every week you can record every single one of those withholdings and taxes and liability accounts. A little bit more complicated. You really need to work with someone who has a lot of experience to do that. But those are your 2 options for payroll. The next item that we see is in deposits. When you are getting deposits and you're using a point of sale system such as Square, what we find a lot is that you are not capturing the fees that POS system is charging you. So let me take a quick look at that and what that would look like. So we have a deposit here for $200. Let's assume it came from Square, and we know that Square takes their fee out before they give you your deposit. All right. So in fact, your sale was $205, but they took their $5 fee, and what you have remaining is $200. So we need to capture that. We do this one way to do this is by splitting that transaction. So receive from Square or Square customer. Oh, for something, right? And it really was $205. But we know that Square all right, they don't like me doing that, so I'm going to put Square customer again. That Square charged you $5. So in fact, I'm going to call this a bank charge, it could be a merchant charge, is actually a $5 fee. So I'm using a negative number, which nets that deposit out to the 200 it should be. So you want to make sure that you're capturing all those fees. They can add up to a lot of different money. All right. And then finally, the last one that I see a lot is really about interest, and just making sure that you understand that there are really 2 different interest categories. One is interest income, which is money we receive on our bank account, right? That 3 cents or 5 cents or 2 cents or whatever it is, versus income expense, which is an expense item that might be associated with one of your loans, right? The principal and interest thing. I see a lot of people who just dump them all into just one category, and then you'll see negatives and positives, and it just doesn't come out right. So you want to make sure that you have 2 different interest categories. One is interest income and one is interest expense, and making sure that you are categorizing those transactions correctly. All right, that was really quick, I know, but I wanted to try to show you some of this. And I am going to, all right, let Tina take it back.
Tina, we can't hear you. But you're doing great otherwise.
Can you hear me now?
Yeah.
All right. So, you know, all of this stuff, and we know we went through this quickly, but wanted to highlight some of the very, very common things we see all the time. When you are doing your books, there's lots of sources of information. And the first, of course, is the Maine SBDC. And as I said in the beginning, you can set up a time to meet with a business advisor who can then set up a time to meet with Kitty, and over Zoom, we can look at your books and see what might be happening. So if you notice that any of these things we talked about or something that you might be doing, but you still need some help in how to actually do the transaction, we can help you with that. And also, you know, obviously your own accountants and bookkeepers. And I think it's really important to understand, and maybe Kitty can talk about this too, about what is it that an accountant does for you versus a bookkeeper? What kind of services are available to you? You know, accountants tend to focus on taxes, but they often have bookkeepers who work on their team or that they can recommend, who can, sometimes people set up relationships where you put in the transactions, but someone else is going to go through at the end of the month and reconcile your accounts. There's all kinds of different ways you can set up bookkeeping. And I think sometimes people feel like they're just kind of out there on their own, but you can find those services. Even, you know, there are actually bookkeeping services you can often buy through your software. QuickBooks has bookkeepers who you can hire and talk to them over Zoom. I can't vouch for the services at all, but they are available. And then there's just tons of training videos all over the place for different software programs. There are a lot for QuickBooks just because it is by far has the largest market share in the United States, but there are other software companies like Xero, Wave, you've probably heard of. It's a free service. They all have training videos, training materials. And then on our YouTube channel, there's 3 webinars that might be of interest to you. The first is just called Financial Report Basics, and it's just going to go over how these financial reports work and how you analyze them. Second one we did was on understanding the chart of accounts, and then also one on just tracking your business and the different types of systems you can use to do that. So lots of help. You shouldn't feel like you're alone. And you know, hopefully this has given you a little bit of a heads up of some things to be aware of, because we all of the things that Kitty talked about, we both see quite a bit. So I'm going to end my share here, and let's if there's any questions, we can take those.
Awesome. Well, thank you both. I saw Patty raise her actual hand, which I always love. So feel free to unmute yourself and ask anything.
Do you guys happen to have like a chart of accounts that you can share as an example, like something basic? I'm dealing with quite a large chart of accounts that I think, are we able to kind of pare it back from being kind of blown up?
Yeah, you absolutely can customize it to fit your needs. If you're using QuickBooks, when you sign on, they ask you a bunch of questions, and then they dump a template that they think is the closest. It usually ends up having a lot of different categories that you don't need. But if you go to any of those categories and you go over to the far right, there is a little drop down, and it says make inactive. You can make it inactive and it will not show up. So it helps clean that up. So you might try spending some time just cleaning that chart of accounts up. They won't let you delete anything, but they will let you make them inactive.
Right. So you don't have kind of just a basic kind of what you shown earlier that people can use as a guide?
I don't actually have one on hand, because typically I'm using what's in QuickBooks and then just customizing it. But I'm sure that there's some basic ones out there for your basic categories.
And Patty, a lot of those are industry specific, which is why QuickBooks, when you use it, it asks you all kinds of questions about what kind of business you're in and what your NAICS code is, and because it's gonna pop in accounts that they think you're gonna want to use. So that's one way to look at it. But yeah, it would really depend on what the business is.
And Patty, I also stuck a link in the chat that goes to an older video of ours that's like the difference between S Corps and C Corps. I don't know if there's bookkeeping information in there, so I can't vouch for that, but that might be helpful from your earlier comment. I don't see any other questions, but if anybody has anything, feel free to plug them in the chat or raise your hand as well. I think there's a digital hand. We've got, hopefully.
I think Michael has a question.
Yeah, I do. We've recently upgraded from a prehistoric version of QuickBooks to QuickBooks Online, and we're having all kinds of problems making that transition. I'm wondering if there's a way to get help through the Small Business Development Center, an advisor or something, and what the best way to do that is. I think I'm making all the mistakes that you went over.
Well, I also think too that if you were raised in QuickBooks Desktop, you go to QuickBooks Online, there is a bit of a shell shock there, right?
Yeah,
it does not look the same. It does not feel
no, we've been relying on the bank feed to deal with everything, and I feel like I need to get over that and really get on top of it.
Yeah. Michael, if you wanted to sign up for advising, we could then meet, and then we could set up a time with Kitty. There's also, if you are having trouble with like the actual conversion, you may need to speak with QuickBooks themselves.
Yeah, we got the conversion sorted out more or less. I lost a lot of data, but so yeah, it's more just dealing with the day-to-day stuff.
Yeah.
Differences. So.
Yeah.
And so much of that goes back to what Tina mentioned about workflows, understanding workflows, right?
Yeah.
Are you using invoicing? Are you entering bills or not entering bills? Once you understand that, then the bank feed, which is sort of the center of the universe, you know better how you have to deal with that.
Yep.
I also just wanted to mention that I think there's a little bit of conceptual confusion about the bank feed because people will connect their banks. And the idea behind connecting your bank to the software is that the individual transactions flow into this section of QuickBooks where they don't go into your books until you actually categorize them.
Yeah.
But people often use only their bank feed, and you want to, in some cases, also enter the transaction manually into your system and then match it in your bank feed. And the reason for that is if you're only relying on your bank feed and you're not putting in some transactions yourself, you are just completely relying on what the bank is telling you is going through your bank account, but there may be some mistakes in there from what you thought you were doing, or you kind of want to figure out which transactions are worthy of putting in yourself. Like when you write a check, you can use checks from QuickBooks and actually have them print out of the program, and then it gets put in manually, and then when that comes through your bank feed, you'll just match it versus adding it in. But I think there's a certain degree of danger of just like relying completely on the bank feed. I don't know what you think about that, Kitty, but I think that's a big change, is that bank feed.
It was done for efficiency's sake, but we've sort of overdone it, right? Again, it goes right back to understanding your business and your workflows. It also goes back to understanding, are you using cash accounting, accrual accounting? That all plays into how much you enter, right?
But we'd be happy to take a look at whatever issues you think you might have going on in there.
Awesome. Thank you.
I was just wanting to say one other way, if you're using QuickBooks Online, I'm a bookkeeper. I have my own company, is you can go to the Gearbox and check out the audit log. That's a good way how you can track what sort of things you've done, what sort of transactions you've entered. You can audit and edit some of those transactions. So the audit log, it's like a transactional record of your previous 20, 30 transactions. So it's a good tool to use. Yeah.
There's also, just if you are kind of learning, in this case, QuickBooks, there's a lot of YouTube channels that have training on them, and some are better than others. I'm happy to share some of the ones I follow. that I just like them, but there's better ones, but there's so much information out there.
Yeah. I always say those videos are fantastic if you already sort of understand the platform and how it works. If you try to do those videos as a brand new QuickBooks user, I think they can be because it's one snippet, and they don't sort of tie it all together. So if you're brand new to it, I'd say hold off until you get a little bit of experience and then use those videos, which can be extremely helpful.
Mm-hmm.
If I could just make one more recommendation, I'm not sure if it was touched upon here. There is another software that I myself am certified in. It's called FreshBooks. You can check it out. It's very similar to QuickBooks, and it provides some options. It's simpler, in my opinion. There aren't as many bells and whistles as QuickBooks, but I think for like a general basic business, it does the job. So.
Yeah, and Ivan, just so you know, we actually have a webinar we did on some of those different options and compared those different software options. You know, in no way do we only promote QuickBooks. It's just that it is just such a large part of the market in the United States. I know FreshBooks is a Canadian company and it's very popular in Canada, and Xero is an Australian company and it's very popular for Europeans. But you know, it's a global economy. Everybody's using everything.
There were a couple of comments that it's helpful in these scenarios where people are asking questions they think are just helpful for themselves, because other people are saying the prehistoric QuickBooks to the online is a good cautionary tale for switching over. So that's great. And then there was another comment: beware of the QuickBooks Online updating every so often and the buttons slightly moving.
Yeah.
So there's always those kinds of learning curves. We did have a question from Jerry. I am purchasing a product-based company and want to input the transactions and have someone reconcile monthly. I've heard that QuickBooks is not very strong as an inventory system. Can you suggest what I might use?
I can say something, Kitty, unless you want to take that.
No, you go ahead.
So that with QuickBooks Online, there's different versions, and the one that is strongest in inventory is the more expensive one. There's basically 4 versions of QuickBooks Online, and I think you need to go to the advanced version in order to get really robust inventory management. I think you can do it also with I think it's, let's see, there's Simple Start, Essentials, Pro, or Plus, and Advanced. Yeah, I think Plus might give you that inventory too. And a lot of people stick with the desktop version for inventory management because it seems like there's a lot more options on the desktop version. And just so also people understand, QuickBooks used to be, and Kitty and I were talking about this a couple months ago, used to be that you could just buy the desktop version and not have to pay a monthly fee. Whereas with QuickBooks Online, you're paying for the privilege of having an online account. But they just changed it so that even if you get the desktop version, you still have to pay a monthly fee for some of the connectivity and other services, and you're required to do it. It's no longer just an option. But the desktop version, I believe, and Kitty, correct me if I'm wrong, but I believe a lot of people feel like it's better, that especially the advanced versions of the desktop are really good for pretty robust inventory management.
Inventory can get very, very challenging. So you really do need a product that fits that. I mean, that's just the word on the street, that when you're getting to that level, that desktop still might be your best bet over online.
Yeah. And
could I just butt in real quick and just add something? The desktop version has a enterprise option, which is basically the online desktop version. And actually, one of the things sometimes that I recommend is you can have both a desktop and a online company. So in the desktop version, you can export your data to QuickBooks Online. So you can technically have your same desktop data in QuickBooks Online. So just something you may want to think about.
Here we go. And it seems like a lot of people are struggling with this inventory aspect. So you are not alone. One person mentioned they're using the manufacturing version of QuickBooks. So I guess there's a couple different options.
Yeah, yeah, in desktop.
Dawn says they left QuickBooks because it was more complicated than they needed, but Waves has been amazing. So there's definitely, some different options. Blaine is just in the process of buying an online membership and will be starting everything from scratch. So it's good that they're being proactive about avoiding some errors. But again, it's all a learning curve. So along the way, we're happy to help if you have additional questions. It looks like we're just at time. So if you have to jump off, we understand, but I think we'll stick around and answer a couple more questions. So Mary Ella is asking, what type of account should subcontractors?
Yep.
Oh, sorry. Should subcontractor payments be?
That's a great question. They are an expense item for you because at the end of the year, you need to provide a 1099 for each subcontractor that you have paid $600 or more. So you want to be very careful about your setup that you can identify them easily and separate them out and run your reports at year end.
There was a question from Elizabeth about asking about fees for a bookkeeper to set up QuickBooks. Kitty, you want to take that one?
It goes all across the board. It really does. I don't think there's really any good setup or any good standard fees out there. What I recommend is that you have a really good conversation with that person and you are pretty clear in your mind of what it is you need, right? Some bookkeepers charge a monthly fee, but then would charge an additional fee for the setup based upon the complexity. How many credit cards, how many bank feeds, right? How many different account types. So it could really vary. I would hesitate to throw anything out there, but happy to kind of have a conversation and help you troubleshoot that question.
Yeah, and I'll make sure that all of our contact information is in my follow-up email tomorrow so that it's easy for you to get in touch with any additional questions. Sign up for advising if you're not already set up with one. We really encourage it, and we have been so lucky this year to be working with Kitty and a couple other marketing specialists that you wouldn't otherwise have this access to so easily. So thank you, Kitty. Thank you, Tina. We got lots of thanks in the chat. I don't see any other questions. We want to be respectful of everyone's time. So thank you all for joining us today, spending your lunch with us. I guess it's a little later in the day than usual, but I'll send all of those resources out probably tomorrow. But otherwise, we hope that we'll see you at the next event.
Go enjoy the sunshine.
Yeah, bye everybody.
Bye.